Angel investing involves providing capital for business startups, often in exchange for ownership equity or convertible debt. These investments can be highly rewarding, but they also come with a significant level of risk. Here are some of the key opportunities and risks associated with angel investing. Before we begin, please like and subscribe to our channel. Opportunities. High return potential. The allure of angel investing often lies in its potential for high returns. This is especially evident in startups, particularly those within high-growth sectors like technology, that can exhibit exponential growth. When an investor gets involved at these early stages, the potential exists for their initial investment to multiply significantly. The substantial returns for an angel investor generally materialize when the company they've invested in is sold or goes public through an initial public offering (IPO). These events, known as successful exits, can lead to extraordinary profit. In addition, angel investors often receive equity, meaning they own a certain percentage of the company. If the company's valuation surges, even a small ownership stake can be worth a considerable sum. In certain cases, angel investors may also benefit from preferential treatment, further enhancing potential returns. Diversification. Diversification is another major opportunity presented by angel investing. In the context of investing, diversification refers to spreading your investments across different types of assets to manage risk. The idea is that if one investment fails or performs poorly, others may perform well and offset the loss. In the case of angel investing, this means investing in a range of different startups across various sectors and stages of development. It's important to remember that most startups fail, but a few successes can generate enough return to cover the losses and potentially produce significant profits. Moreover, angel investments offer a type of diversification not easily achieved with traditional investments, like stocks and bonds. The success or failure of a startup is often determined by factors unique to that company or its market, and is less correlated with the overall economic cycle. This lack of correlation can be beneficial in a diversified portfolio, as it provides a level of insulation from broader market volatility. Innovation exposure. Angel investing grants investors unique access to cutting-edge innovation and disruption. This means they have the opportunity to support and partake in the growth and development of groundbreaking technologies, products, and services right from their nascent stages. This kind of exposure can range from investing in advanced applications of artificial intelligence and machine learning to supporting innovative biotech therapies, renewable energy technologies, and more. Being part of such innovative ventures allows investors not only to potentially benefit from significant financial returns if these startups succeed, but also to contribute to advancements that can reshape industries or even society as a whole. Furthermore, this exposure to innovation can provide valuable insights and knowledge about emerging trends and sectors, which can be advantageous in future investment decisions and broader business strategies. Active involvement. Angel investing is distinct in the opportunity it provides for active involvement in the invested startups. Unlike many traditional forms of investment, where an investor's role is largely passive, angel investors often engage directly with the operations of the businesses they fund. This can involve providing mentorship and guidance to the founders, leveraging their own experiences and insights to help navigate the inevitable challenges associated with growing a business. Further, angel investors can offer valuable networking opportunities. Their connections within the industry can facilitate introductions to potential partners, customers, and even additional investors. This active participation can be deeply rewarding, not only in terms of potential financial returns, but also through the satisfaction of helping mold a nascent idea into a successful enterprise. This engagement also provides investors with invaluable experience and insights, which can be beneficial for future investment endeavors. Risks. High risk of failure. Angel investing inherently carries a high risk of failure, a fact that potential investors must come to terms with. Statistics indicate that approximately 90% of startups fail. illustrating the stark reality that the chances of losing one's entire investment are significantly high. Some startups may not generate any returns at all, while others may even lead to total loss of the invested capital. Market volatility, unproven business models, management missteps, and fierce competition are among the many factors that can lead to a startup's demise. Moreover, factors such as regulatory changes or global events can create unexpected challenges that may derail a startup's progress. Therefore, while the potential for high returns is a major draw in angel investing, it's crucial to remember that these opportunities come with substantial risk. Liquidity risk. Liquidity risk stands as a significant factor in the realm of angel investing. Unlike investments in stocks or bonds, which can typically be bought or sold with relative ease on public markets, investments in startups are typically highly illiquid. This essentially means that once capital is invested in a startup, it is often tied up for several years, as most startups do not have a quick exit strategy like an initial public offering, IPO, or an acquisition. During this period, the investor generally cannot sell or cash in their investment, which means they need to be prepared for a long-term commitment without the certainty of returns. The inability to quickly liquidate the investment can pose a risk if the investor's financial circumstances change or if they need to adjust their portfolio. Additionally, even when exit opportunities do arise, the process may be complex, and the final valuation may not reflect the anticipated return on investment. Thus, liquidity risk is an essential consideration for any potential angel investor. Lack of control. Lack of control is a significant risk factor in angel investing. While investors often contribute capital, offer guidance, and bring valuable networking opportunities to the table, they typically do not possess direct control over the startup's day-to-day operations or major strategic decisions. This lack of control means that investors are placing a considerable amount of trust in the startup's management team, whose choices can make or break the business. If the team makes poor decisions, mismanages resources, or fails to execute effectively, the investment could be in jeopardy. Furthermore, startups are inherently dynamic, often pivoting or adjusting their business strategy in response to market feedback, competitive pressures, or technological changes. These shifts can drastically alter the company's trajectory and potential for success, introducing additional uncertainty and risk for the investor. Similarly, unexpected changes in the leadership team or company direction can occur, further highlighting the lack of control risk within angel investing. Due diligence requirement. The due diligence requirement represents another crucial aspect of angel investing. Due diligence refers to the comprehensive appraisal an investor should undertake before making an investment to establish a venture's viability and assess potential risks. It often involves assessing the startup's business model, market opportunity, competitive landscape, management team, and financial projections, among other things. This process can be time-consuming and complex, necessitating a strong understanding of business and industry dynamics. It also often requires access to relevant market data and potentially legal or financial advice. Therefore, the necessity for thorough due diligence can pose a significant challenge, particularly for less experienced investors or those without the necessary time or resources to conduct it adequately. If due diligence is not conducted appropriately, investors may overlook key risks, leading to poor investment decisions. Therefore, the due diligence requirement is not only a fundamental part of angel investing, but also the potential risk if not carried out with the appropriate rigor and expertise. Valuation challenges. Valuation challenges pose another significant risk in angel investing. Determining the accurate value of a startup can be a complex and often subjective process. Unlike established companies that have clear financial histories and steady revenue streams, startups often lack these and therefore, their valuation is frequently based on future projections and potential, making it more speculative. This can make it difficult for investors to ascertain whether the price they're paying for their share of the company is fair. Overvaluing a startup can lead to inflated expectations and potentially lower returns, increasing the risk of the investment. Further, there's often a lack of standardized methods or criteria for startup valuation, which can create discrepancies and disagreements between founders and investors. The process can be influenced by various factors, including market trends, the startup's industry, competitive landscape, and the team's background. Therefore, the challenge of accurately valuing a startup adds another layer of complexity and risk to angel investing, making it imperative for investors to be thorough in their due diligence and potentially seek professional advice. Conclusion: while angel investing offers the opportunity for high returns and a chance to participate in innovative ventures, it's not suitable for everyone due to its high-risk nature, liquidity issues, and the significant effort required for due diligence. It's advisable to invest only money that you can afford to lose and seek professional advice if you're new to this type of investment. That's all for today's video. What are your thoughts on this? Let us know in the comment section below. And make sure to like and subscribe to